The Hedgeless Horseman here. It's June the 11th, 2024. I'm gonna be trying to make more videos because I'm feeling better. And there's a lot of stuff to talk about. And especially I was gonna say, since it's kind of a lull in the junior sector. I mean, summer's obviously arrived. And seasonality suggests that gold could be near a low, or June tends to be a low on average. I'm not saying that's gonna happen or gonna be the low or anything like that. I'm just saying that the last few weeks we've had some choppy action in silver and gold, and I think juniors have done well. I mean, most of them have kinda held their levels, but there hasn't been much excitement yet, and of course that also coincides with the fact that the many northern explorers in Canada, for example, they haven't really been able to do much work yet. And as we know, I mean, everybody loves greed, I was gonna say. So when people see other people starting to make money on stuff, or they see stock prices go up, then all of a sudden they get reminded that, oh right, you can actually make money in juniors. I mean, that's why everybody's going to be buying in at the next sentiment top, for example, because there's going to be so many examples that people have actually been able to make money in juniors, and that makes them believe that they can make money in juniors. But in a bear market, in a 4-year bear market, when there are very few examples of anybody making money in juniors, nobody sees a reason to buy them. Despite the fact that, well, if it's gone down for 4 years, we can imagine how much it's going to go up when the bull arrives. But that's obviously not how people work. People don't sell something because it's expensive. People sell something because it has been going down. People don't buy something typically because it's cheap. They buy something because it's gone up, and that's never gonna change. That's why I don't think contrarianism and value investing has maybe ever been better than it is now, because as we know, I would say every new generation kinda has gotten, especially in the modern day and age, has gotten more impatient. Everybody wants that free lunch. Everybody wants instant gratification. Everybody's very, let's say, focused on appearing successful, I was gonna say. And in the junior space, which I've claimed quite a few times, I mean, I typically look more wrong than right. The bear markets tend to be much longer than the bull markets and all of that, so you kind of have to be okay to look stupid for a long period of time before you maybe make it all back in 20% of the time, compared to how long you look stupid. So I mean, if you want to look smart and want to look right all the time, I guess that's why momentum trading why the bubbles we see might be exaggerated, because there's never been perhaps more investors that are focused on the recent short-term trade. And if you can't stomach looking wrong, I don't think you should be in the junior mining space, because again, most of the time all we do is look wrong, especially in any time frame, at least. I mean, I've shown the Great Bear chart, for example. Even though it became a 20 bagger from discovery to the end, or maybe a 30 bagger, I don't know, still Great Bear, that chart was consolidating for most of the time over that 3-year run. Had numerous big corrections. So if you can't stomach holding a junior, if it goes down 30% or 50% or 60%, you're never gonna get a 10 bagger. But how many can stomach that? And how many actually do end up getting a 10 bagger? I find it extremely hard, not the volatility per se, but the weight. Because we will know there's always something. There's always some company out there that's drilling in a sense. And value investing is very straightforward. You buy something you think is cheap, and the only strategy really is to hold it until the market agrees with you. And you have no idea how long that can take. But that's the whole premise of value investing. You own something you think is undervalued, and one day it's gonna be closer to fair value, and someday it's probably gonna overshoot fair value. But it's not a action-packed or sexy strategy. But in my opinion, it does work, especially since value investing is very much contrarianism in this space because it's so volatile. When stuff goes down 80%, when this sector goes down 80%, and let's say everything is cheap, you're by definition a contrarian. Even though I don't like to see myself as a contrarian. It just looks that way when you, let's say, are a value investor. Because if the trend has been down for 4 years and nobody likes the sector, but it's cheap, you're buying because it's cheap. You're not buying because you're a contrarian. But other people are going to look at that and say, what a contrarian. Even though I don't know what's so contrarian about it. I mean, if you're a value investor, buying high is contrarian. Or buying expensive is contrarian, even though most people are going to look at it. Yeah, it makes total sense to buy this because look at the trend. It's been going up. Anyway, thanks to the sponsors. Markets, silver's been chopping a lot. Gold is doing quite fine today. Copper is actually got hit by a decent amount last few weeks, but it's like I've been listening to some podcasts or interviews about copper. It's like nothing really changes. That's the fun part. I mean, it's kind of written in stone already, at least in terms of the supply. I mean, we had copper did quite well over, how long was that? Let's see here. I mean, it stayed at all-time highs for 2 days, or 3-4 days, and now it's already back a bit. Not only a bit, but it's like a decent amount. How many mines do you think got started during that 4-day period when copper prices were actually, I mean, relatively high at least? It's not like it's I don't think they are as high as gold is, comparably speaking, if you know what I mean. Well, gold is obviously right now closer perhaps to the all-time high, but still. My point is, like, what really changed? Are new mines going to be popping up? Is the expected supply shortage going away? No, it might have brought on some supply, for sure, and maybe some substitution or whatever. But I haven't seen any announcements of, with copper being that high, all of a sudden a big mine just got brought on. No, so it's kind of written in stone. That's the beauty of it. I mean, the case for copper hasn't changed this much as the price, if you know what I mean. But it's volatile, and silver, for example, I mean, it's been declared a bull and a bear market almost every day. I mean, is it totally unbelievable that this could be some kind of a bull flag? I don't know. Again, I don't trade based on this. What we do know is that, okay, silver usage in solar is still going up and expected to go up even more. So, I mean, I think silver has a pretty bright future ahead of it. I mean, when you think about it, okay, where does most of the silver come from? Well, it comes from polymetallic mines. Gold mines, copper mines, zinc mines, base metal mines, basically. Fixed supply. And we haven't started many new big mines like that. And every single mine in operation today is getting older. So, I mean, the copper supply shortage is expected partially, of course, because there's aging mines that are gonna stop producing. And if you run out of a big copper porphyry body with 8 grams per ton silver or whatever that might be producing X amount of millions of ounces, when that copper supply drops away because they shut down the mine, that silver production also goes away. Of course, the other side of the coin is that, hey, if we someday bring in a bunch of more copper porphyries because copper is high, that's going to bring on a bunch of silver. But the beauty of it, I guess, it's that that's some ways off yet. I mean, people have been saying that, that it's almost written in stone because exploration for copper should have been seen more money going into it for the last 2 decades to prepare for the upcoming supply shortage and all of that. So, that's why I'm kind of bullish on almost all metals. Because it seems the mining sector has kind of the same problem overall. Not been investing enough. Permitting's actually been getting harder while demand has been going up. So I thought I would actually talk mostly about porphyry plays, but I'm gonna touch on this news from Eskay Mining as well. Eskay Mining and P2 Gold agree to combine to focus on gold and copper exploration and development in the Golden Triangle in Nevada. Mac comments, with this transaction, Eskay has taken a significant step towards finding the next major resource in the Golden Triangle. The P2 team, led by Joe Ovsenek, is second to none in producing results in the area. The addition of Gab's property in Nevada puts Eskay on a totally different level as a resource explorer. I mean, obviously, Eskay's jewel is their land package. They have a big land package. They control most of the Eskay Creek district. We know there's Bleg sample anomalies that are like a few or tens of kilometers long. And there's 3 main anticlines. So it's in a very prospective area of BC. They own a large land package. There's smoke all over the place. And Eskay hasn't been doing much when the bear market reached its peak, basically. Which makes sense. Because, again, the jewel with Eskay is their land position in that part of the world. Because, gold, silver and all of that, that's rare. I mean, it's hard to find a deposit. But prospective ground in very prospective ground in a tier 1 jurisdiction, that's the most finite thing in the world. If one would start to explore all of Africa, it's like the really bad parts of Africa, there's probably a lot of gold and silver there. Same with some, let's say Venezuela in Latin America. There's probably a lot of gold and silver in a bunch of places around the world where we're not looking for mostly, I guess, geopolitical and political reasons. But that also highlights that, again, not every jurisdiction is a tier 1 jurisdiction. Not every jurisdiction is a first world, is a first world country. And where you have those first world tier 1 jurisdictions, it's not like all the ground is prospective for good deposits. Take Australia, for example. The only real area, and Australia is not a small country. Tier 1 jurisdiction, first world country, rule of law, English speaking, produce a lot of metals, but in the copper porphyry space, for example, it's only real the Macquarie Arc that has shown to be able to host tier 1 copper porphyries. So that's a very fine, even though Australia is just tier 1 jurisdiction, very large tier 1 jurisdiction because it's a large country. Still, the actual area where you would like to, or could be able, let's say, to find big copper deposits is in a very limited area in that whole big country. So that's extremely finite. Again, it's like you don't make more ground. Stuff that's been in place, deposits that have been in place, they might have been there for 1 billion years. We're not making more deposits in tier 1 jurisdictions every day. So that's basically not going to change. So it's basically been set in stone since sometimes up to billions of years. So that's, in my opinion, that's why I've probably talked a bit about, I like the idea of like building real estate empires. Because the only thing you can't make more of is land. And prospective land, again, that was set in stone millions or billions of years ago and hasn't changed, and it's not going to change in our lifetime. So what can be more finite than that? You can build a city and all that, but you can't create you can't make the world create more porphyry deposits on a whim. So that's why I really like district scale plays in tier 1 jurisdictions, again, or district scale plays, real estate plays if nothing else, in tier 1 jurisdictions. Because I have a hard time seeing that, yes, politics change and all that, but I don't see Africa overtaking the Western world anytime soon. And it's like, where would you actually want to own a very valuable deposit? Even though we have the ESG and you had hard times permitting, but I think that's also gonna change in a way, given that if metals go up and everybody's talking about critical minerals, the world is kind of waking up, especially the Western world, waking up to the fact that they need to secure strategic supply. So I don't know exactly how, what the path forward is going to be for Eskay, the combined Eskay mining and P2 gold entity. But it's like, hey, as long as they keep their land package, and if, let's say, this brings more eyes to the story, etc. Again, in my opinion, Eskay's, there hasn't been a lot to talk about Eskay. But the most valuable thing Eskay has is not the news flow or the last 6 to 12 months. It's their properties. It's their slice of the world. It's their land package in the Eskay Creek district, where I think there's a lot of potential, as suggested by the leg samples. That's why I really think some juniors are out there are just absolutely mind-numbingly cheap. Not necessarily based on exactly what they have proven up. Some because what they've already proven up is selling for cheap. But it's like the ones that in a bear market have controlling land positions in tier 1 jurisdictions. But nobody really cares. They get no value for it. Even though, again, fast forward, we're looking for the delta, right? The value change. So, a perfect example, I guess, would be like, when industrialization started to take place and the mega cities around the world started to happen. So if you bought, and there was obviously people that get very rich from just buying undeveloped land in the outskirts of large cities. Maybe they bought them for peanuts. But when the cities around the world started to grow, all of a sudden, the city reached, it grew out to the area where, okay, this was just, unworked land, just whatever, fields and semi-desert, I was going to say, in the case of maybe Las Vegas and stuff. But all of a sudden, that land went up in value. So if you have that kind of foresight, because that's what I consider like right now, if this is a dirt cheap sector, and some juniors out there, when nobody cared, they bought or were able to consolidate, so they own, a big patch of land in a tier 1 jurisdiction, let's say primarily tier 1 jurisdictions, and they get no value for it. It's like, what happens one day? Let's fast forward 5 years. Let's say copper is at, I don't know, $15 per pound. Let's say there's a gold rush. Let's say the world is a bit more chaotic. Let's say the unipolar world is falling apart a bit, and it's like the dollar is taking on water, and all of a sudden it's like everybody loves real assets, hard assets. So what do you do what do you think the real estate value might be if you have some of the most prospective ground in the world in an area where people actually would want to have a deposit, in a country that actually needs the metals for strategic reasons? Are they going to be selling for 10 million market cap or whatever? I don't think so. So in my opinion, I see this sector right now kinda like someone buying undeveloped real estate outside of a big city hub, and you kinda know that this city is going to grow. All of a sudden, this worthless ground, let's say it's you can't really do agriculture or anything like that there, but when the city grows, all of a sudden that ground is going to be there's going to be people wanting to build houses there. So it doesn't matter if, in that case, it doesn't even matter if the ground itself was prospective or not. But with time, when the city reaches that area, people will pay to be able to buy houses on it. So just the fact that you own the land, and it's nothing special in that case with the land, it's just where it's located. So if you bought it because you got it for extremely cheap prices, because nobody could really make any money on it at the time, because there were no natural resources, and there was again no way of growing anything, selling, making money. But for housing purposes, all of a sudden value shot up. Obviously we can see that again in some of the bigger cities nowadays, where you have places that's kind of grown together, and as the city widens, the city center kind of stretches as well. So 80 years ago in some cities, if you lived on the outskirts, that might be the city center, or within the city center today, and the housing prices might be exponentially higher than the value put on them at the time, because at the time when someone bought it or owned it, it was very much at the outskirts. And today, again, given how some cities have grown, all of a sudden that's like a central area of that city, and even a small patch of land might fetch extremely high prices, let's say. Just look at the real estate bubbles in let's take central Vancouver, Toronto, whatever. Yeah, so this is a long rant, I guess, about not much else than to point out the fact that yes, gold, silver, copper, zinc, nickel, etc., they are rare metals, at least in economic quantities or economic concentrations, but they can still probably be, and we're going to find more of them around the world, but tier 1 jurisdictions, the ground, the actual country size or whatever, that's finite. Canada hasn't really shrunk or expanded for a long time. Same with the US. Same with Europe. So we don't really create more tier 1 ground, tier 1 jurisdictional ground. And within them, there's few areas that are very prospective for certain economic quantities of metals. which the world has been needing more and more and more of. So that's my point, I guess, that I kind of see myself as someone who's buying up real estate or land just outside a major city, and I can buy it for peanuts right now because nobody sees the value of it. But when in time, the implied value is going to go up as the city expands again with time. So that's what I really like. I mean, when I find juniors that they might have a proven deposit already, a proven resource, you can buy the resource for pennies on the dollar. The company has expanded its land package or has a huge land package. It's like, by definition, if you're not even paying for what's already proven in just one sliver of the land package, a deposit, because a deposit's footprint of a big land position is obviously like, almost not like 0.001% of the land package. So if you can buy that for less than it's worth, all the real estate comes for free, by definition. So if you can buy 50,000 hectares, whatever, of prime ground for nothing, and you know it's prospective, and you know people are going to look at that ground one day and it's like, whoa, now everybody wants gold and silver. Where do they want it? Well, everybody prefers a tier 1 jurisdiction. All of a sudden, the appetite for that land position, that potential alone might be so high that you could basically joint venture or spin off parts of the projects for more than the actual total market cap of the company is today. That's an ace in the sleeve. You already bought something you know is cheap. So as a value investor, you already jumped on an opportunity, and there's still aces in the sleeve, meaning that, okay, if I got all this ground for free, somebody's gonna want that ground badly someday. And I got it for free in 2024. That's my point. Because we know, I mean, you can look at closeology plays. Someone makes a discovery, the story gets hot, all of a sudden all the surrounding ground gets revalued by a lot. I mean, I've read some stuff about the Eskay Creek rush, actually in particular, when they made the Eskay Creek discovery and the Hemlow discovery, for example. It was not only the juniors that had those discoveries that went up a lot. All the surrounding real estate went up a lot in price, like hundreds of percent, maybe thousands of percent. That's the thing I'm talking about. But obviously, I would rather prefer to actually buy prospective ground than moose pasture that's selling for nothing and hope that someone makes an out of the blue discovery and all of a sudden the moose pasture goes up. But if we can buy proven prospective ground for nothing right now, how is that a bad deal? That's what I actually like, the idea of, like, you know, you have the, you know, Brixton Metals, for example. Oh, they own a huge land position. They own a small country. First Nordic. They own an entire belt. Inflection. They own 200 kilometers of the Macquarie system. Stuff like that. Very finite stuff, because obviously, again, you don't make more of that. The Golden Triangle has had the same size for the last, I don't know, millions of years at least. That's a very finite spot. So let's say, theoretically, one could buy all the land of the Golden Triangle outside the actual operating mines or whatever for free today. Because let's say nobody cares. Imagine what that could be worth one day when it's like, oh, the copper mines, they've run out. There's obvious copper potential in the surrounding area. So copper prices are high. Everybody's panicking about getting copper. How much do you think you could sell the ground with copper potential in that case? Well, you could probably sell it for a lot. That's my point. I mean, you kind of, as investors, we obviously want to, focus on value, let's say, but we also want to front run big changes, big deltas. I mean, that comes from typically in this sector, sentiment is the most obvious delta. And there's themes of sentiments, like the sector overall, but also that, hey, maybe a copper theme is going to go higher, or given that even the US government is throwing money at critical minerals. Maybe there's going to be a critical mineral frenzy one day. So if I own all the land, or parts of the land, that's what I really like. I mean, just the idea that, if you only had a few juniors with like huge land packages in the tier 1 jurisdictions, in the prospective areas for different metals, you might have direct interest in, let's say, a significant part of where the metals have to come from in the future to supply the Western world. That is very attractive to me. It's like your Dr. Evil, I was going to say. But in a good way. Even water today has become a kind of a precious commodity in a sense, which is interesting. Anyway, long rant about not much else than kind of explain why I really like ambitious juniors in the sense. Quinton has said that as much about juniors. What do the majors want to see? The majors, if they pay up for something, they obviously, or they are ready to pay up if they think they got some district potential. If Great Bear, for example, which was acquired at $1.8 billion, they wouldn't buy just the actual deposit, like a 5 kilometers stretch, let's say, for that much. They obviously, as a major, you want to feel like, okay, I'm paying up maybe more than I should for this actual deposit, what's proven so far. But if I get a huge land package with it, I have no idea how many birds in the bush I'm buying at the same time. And if this is a big mine, let's say it's going to produce for 20 years, I got 20 years on me to explore to find more feed. So one junior CEO told us, like, you always want to leave blue sky, because that's what major companies are willing to pay up for. So in the eyes of the market right now, they might not give a crap if a junior expands the land package. Why? Because the sector doesn't really give you fair value for a proven deposit, like proven success, bankable success. That you get to buy on the cheap. So, let's say again, a junior, we have expanded our land package, let's say in a tier 1 jurisdiction, added more ground with obvious potential. The market won't care probably about that at all. But okay, so the market doesn't care, but is the market right? If you acquire another piece of prospective ground in tier 1 jurisdiction, again a very finite pie, shouldn't that at least give you maybe 1 million in extra market cap of implied value? Well, I think so. But the market doesn't see it that way, because it's looking at, well, right now they don't even care about the actual metal in the ground, the proven metal in the ground. What is exciting about potential? Well, not right now maybe, but I can tell you that's like in a hot sector, when sentiment is high, you get paid for potential. In a bear market, you don't even get paid for banked success. You don't even have to pay up for banked success. You can buy proven, sunk costs for on the cheap. Let's say, stuff that, we have 2-3 million ounces. It cost us 60 million or whatever to prove this up. You can buy it for 20 million, let's say, or 30 million. That's a kind of a free lunch in a sense. But potential, how many land plays do you see or you have any sort of high valuation? Like in a staking rush after a discovery? No. I barely see anyone. But what do people pay up for in a hot sector? Potential. Now everybody's focused on risks to the downside. Everybody's looking for an excuse to sell still, kinda. If they see a quote orange flag, I'm out. If they see some kind of problem, I'm out. I don't want to buy it. People are thinking about not losing right now. They discount risks very highly. They put a lot of emphasis on risks. So if there's a problem with a junior, as someone can see, you have no idea how low they can take it. Same with, there's a risk for dilution. Then all of a sudden there's no price that's too high to sell. But on the flip side, when we go into a hot sector, people are only going to be talking about the potential. What's the upside risks? If they see one avenue for upside risk, that might be enough to buy, even though there might be countless orange or red flags. When stuff goes up, people think about how can I make more money. When stuff has gone down, they think about how can I not lose more money. And again, that goes back to the real estate, because real estate, prospective ground, only really has potential. It has no banked value. And the narrative is going to be, well, there's nothing proven there. You don't know if they're even going to find something. Whereas in a hot sector, people are going to say, they might find something. This has potential, but because there might be another deposit here. That's my point. So with sentiment and all of that, the whole investing psychology is going to change. And combine that with the fact that, we need more metals. So we believe we're in a metal bull market when people are going to appreciate metals more. And we might think that, we're in a gold and silver bull market as well, because we think they're going to appreciate monetary metals more. And of course, if in chaotic times where monetary metals go up, contrary to base metals, people might be buying them out of fear. Wealth preservation. So if you're really scared, and let's say there's no silver or gold to buy, the coin shops are out or whatever, where are you going to go to next? Would you rather buy a cheap gold project with gold in the ground in Sudan, or would you rather likely go to, let's say, Canada or US or Australia where there's gold in the ground? If you're in a fear mode, if you're in a risk-off mode, with metals going higher, monetary metals going higher, so they're going up out of fear, I think people are going to be mostly gravitating towards tier 1 jurisdictions. Because you're in risk-off mode, you're in wealth preservation mode. Do you want to put your money that you're afraid to lose and go and buy something in Congo or something? I don't think so. That kind of goes back to Thomas Kaplan's idea that he thinks there's going to be a bubble within the bubble in the future. That the tier 1 jurisdictions in the mining space, or the companies in the tier 1 jurisdictions, they are, when we go into a, let's say, gold and silver bubble, he believes the valuations of the tier 1 jurisdictional juniors, they're going to be in a bubble within a bubble. Are we paying for that now? I wouldn't say so. And that's the beauty of it. So it comes as a free optionality. One could say that for starters, yes, this should have value because it is actually a tier 1, ground in tier 1 jurisdiction. It is actually prospective for the metals. So implied it should have value, some value, risk-adjusted value. But if you're not paying for it, and then fast forward to a world where, let's say, if Thomas Kaplan is right, you have no idea how much that real estate could be sold for. And you actually get now you get 100% discount, but imagine if you get less of a discount only. Anything less than 100% discount, and you'd make, get a higher price than what you bought it for, which was zero. But imagine a bubble. Imagine the greed train is on, and maybe the fear train is on as well. Yeah, so that's what I think we're front running as well. Because I want to stack the most amount of upside surprises that I can. And if you're buying something for nothing, all the risk is obviously to the upside. That's why I also love the hybrid plays, where Magna Mining, I think, is a good example of this, where you actually buy what they have already proven for less than it cost to prove, let's say, or at least a lot less than it's worth. And they have obvious exploration potential as well. So what risk am I taking as a value investor on the exploration? What if they miss? Well, I still, what they already have is worth more than what I'm paying for right now. What if they miss at the next target? Same thing. But what if they hit? Well, that's at face value, that's risk-free upside. Yes, it comes with some dilution, but still, it's no problem, because it's not like it's undervalued by 5%. Maybe you think it's undervalued by 60%. So you can afford a lot of dilution before you overpay for what's already there anyway. So how do you beat such bets? From a risk-reward perspective, they are or a long-term compounding perspective, they are the best bets. Because sure, you can have a company that all it has is potential, and it could be super cheap based on the potential. It's priced in like there's no chance in hell they're gonna find something. But they're at least gonna test their thesis. Or probably test their thesis. So okay, the market is giving them sub 5% chance of finding something that anybody will care about. But you think it's 15% chance. Then it's undervalued by 200%. Or maybe it's pricing in a 3% chance. And you think the chance is, 20%. Then it's undervalued by multiples. But it's still high risk. And then you got to diversify it away. But compare that to more of a hybrid play, where it's like, okay, I'm buying it for half of what it's worth. Then I get the upside potential for free. So it's like infinitely cheap on the exploration potential, but it's only at half price, whereas you have a high risk, no margin of safety junior, that's like hundreds of percent undervalued, but all of it is still risk, because there is no plan B, there's no margin of safety. So in a sense, at face value, the high risk, high reward stock can be cheaper from a mathematical standpoint, but from long-term compounding perspective, the margin of safety is still kind of king. Making sure, it's what Sun Tzu said. I mean, put yourself in a position where you can't lose. Then it's hard to not win. And of course, that goes back to diversification. That mathematically, if you think a bunch of high-risk juniors have 15% chance of success, but you own 100 of them, 1% each, odds are that portfolio is going to do great, because the actual ones that do make it, if 15 of those make it, and if they make it, they go up 20 to 30 times, then it's going to more than offset the 85 juniors that went to zero, even though most of them actually don't go to zero, they go down at least 50-60%, let's say. So you can make in my opinion, a good portfolio with high expected future returns, even when you take an enormous amount of risk on a case-by-case basis. But if we're talking a concentrated portfolio, you would not want to own 3 juniors with 15% chance of success of delivering a 20-bagger or a 30-bagger. Even though mathematically it might be worth it. But there's also that slim chance that all three, or not slim chance even, let's say there's a 50% chance that all are going to fail. And that's not acceptable when the opportunity cost is that you can buy 3, let's say, hybrids or margin of safety plays where it's like there's a 80 to 90% chance you're going to end up making some money, and there's a chance you're going to make quite a bit of money on them. So from a company, and there's almost no chance that all 3 are going to fail and go bankrupt. So from a company perspective, that's superior is if you have a concentrated portfolio. But I hope you get my point. So in my opinion, what I like about high risk, high reward stories, exploration plays, is that I have a position. Well, typically, I mean, in the case of Condor, for example, when they drilled Pucamayo, I had a very, very large position for a pre-discovery play. And in this time with that campaign, that proved to be I'm not going to say bad decision, because I just can't look at the outcome and say it was a bad decision, but the outcome was unfavorable. And the stock price went down a lot, and I took a big paper loss. And I've sold some of it as well, quite a bit of it. So it's like I converted that to a paper loss. That feels, shitty, of course. But still, that was a bet. If it would have gone well, I would of course be happy that I put in a lot of money in Condor. But that's the thing with speculation, high risk, high reward, that you don't know what the outcome is going to be, so you have to make bets and you have to accept the consequences. Because believe me, if Pucamayo, if they would have proven up P Arena type discovery in the first, let's say, 9 holes, I would go back or I would have regrets that I should have had even more. That's the thing. You never know. So there's always going to be regret no matter. If a story works out, you never had enough. If a story doesn't work out, you had too much. But yeah, going back to the point, I like to, let's say, have, if it's high risk, high reward, and if I think it's mathematically too cheap, and that includes the very high chance of failure, let's say, I still like them, but I have to have such a small, or I have to have smaller positions, because I can't really I can't afford to have again like 3 very high risk, high reward stories. But let's say you have 20% of your portfolio in 20 different high risk, high reward cases. If they all go down 50%, 20 stories fail, you lose 10% of your portfolio, and that's not a small amount, but still it's not going to kill the portfolio. So that's, I guess, my point. I want, or I prefer, because to make it interesting, if I have a 1 to 2% position of a high risk, high reward portfolio play, if that works out, and I think there's potential for this to 10 to 30x over the next 3 years in case of success, that could have a meaningful impact, obviously, on the portfolio, even if 1 to 2% goes up 10 to 30x. But if they totally fail, it's not big enough to kill me, but it's big enough to amount to something. But given the high risk, again, you need to diversify. So let's say you have 20% of your portfolio in very high risk, high reward plays, where it's like, yes, I think beta and the alpha beta plays, the hybrids right now, are superior from a long-term compounding perspective. But if you can diversify the company risk, and you stick to smaller bets, I think there's merit to have high risk, high reward plays. It's again that you can't. Let's face it. Let's say you have a story where it's like, well, you can buy sunk costs for less than they're worth. So by definition, they're cheap, they're buys, and you have this high risk, high reward play with no margin of safety, no sunk cost. You're not buying anything but potential. Let's say you think there's a 10% chance that they have something. They have a target that could be worth $2 billion within the next 5 years. That would be, simply put, worth $200 million today on a risk-adjusted basis. Nobody knows what the exact chance of success is. Nobody knows what the actual value is. It could be, it could even be higher, and it could be a lot lower, and it could be zero if they miss. Still, if you can buy that for 10 million, at least as long as you think there's a chance, because let's face it, let's say you have a 10 million market cap, that's pricing in at face value a 0.5% chance of success of finding something that's going to be worth, let's say, 2 billion within the next 5 years. 0.5% chance. But you think the chance is, well, let's say 15%. You think it's 15% chance. So that on a risk-adjusted basis, that project or that company should have a 300 million market cap. I mean, even if you think you're kinda off, but still you have quite the margin of safety, because again, the market is giving you odds that's pricing in a 0.5% chance of success. So it's like, even if most of the time, majority of the time, 85% of the time, there's an 85% chance or risk of failure. 85, that's a whopper. It's like you should pretty much assume it's going to fail. But if it does not fail, if they find it, if that 15% chance of success happens, let's say you make, with dilution, but let's say 170 times your money. I mean, this is obvious. I mean, we've seen it. We have seen it in the space, especially, some nickel discoveries. My point is that if the 15% happens in some of these high risk, high reward, if the price is big enough, it's gonna pay for a crap ton, if you held it long enough, a crap ton of failures. Let's say you had Great Bear. Okay, let's say you had a 5% position, or let's say 3% position in Great Bear. It went up 20 times. That would amount to 60% of your portfolio, which would pay for 121% positions that get cut in half. That's the beauty of the asymmetrical risk reward in this sector. But you, of course, also, which I discussed previously, you cannot like, I'm doing, I've talked about it. I've done a schematic on it. Let's say you buy a cheap junior, really cheap junior, very high risk, 15% chance of success, 10% chance of success. Let's say 10% chance of success. We go into the assay period, maiden drill campaign. The stock is worth 10 million. It goes up 100%, 20 million. They made a discovery hole, let's say. It opens up 100% plus. And you're like, okay, that's good enough for me. I'm just happy to see green. My portfolio's done, been so crappy, so I'm happy to take the 100% return. So you sell out at 20, even though it's like, well, now all of a sudden, after the discovery hole, now there's a 15% chance or 20% chance they're going to have something worth $1 billion. So the actual implied value is all of a sudden, if it was 3% chance of success before, now it's actually 15 to 20 of finding something worth $1 billion. Then the fair value, risk-adjusted fair value for that company is 150 to 200 million. But you were just so happy to see green that you sold it at 20 after the actual discovery. How is that calculation going to come together? If you know what I mean. That's how many are that going to pay for? If there's let's say 95% chance of failure. If you have 20 juniors, and you only expect one of them to work out. But if that works out, given it's so cheap, given it goes from 10 million to 2 billion, 20 times, then it's going to cover all the other losses. But what if you sell the success cases, the high risk, going into as a result, high risk, high reward cases, the ones that work, you sell them with 100% profit. That's not going to pay for anything. If you cut down the actual trees that are going to end up making it, you take enormous assay risk. That's what I mean. It's like we play the kind of pre-discovery space especially bad, I'm going to say, or it doesn't really add up. Because if we take a lot of high risk bets and the ones that work out, we sell them like immediately on the first uptick, the first 100%, where it's not still even close to pricing in a success scenario. How is that going to afford us to be losing on 85% of the high risk reward stories? It won't. It makes absolutely no sense. That's, I think, I mean, I probably did the same mistake when I started out. And that's the inclination we have, especially in a bad period. As soon as we see green, we're like, oh, I should take my money and run. But again, if you play the high risk, high reward, the only way to capture the, for Great Barrier, it took 3 years for it to 20 bag. So after the first discovery hole, it might have paid for 2 juniors that went down 50%. 3 years later, it would have paid for 60 juniors that went down 50%. So it's fun when you think about it, because we do so much stupid stuff. So in my opinion, the more I think about it, it's like either way, or either we kind of have to do the fire and forget. Like, yes, I understand that I'm, let's say, taking a big risk on 20 juniors, and I have to let them ride, let's say, because there's no other way for a few of them to pay for all the other losers, unless I give them time to see the blue sky case play out. Or we totally skip the pre-discovery risk and buy on a discovery, which typically makes a lot more sense, because again, there's might be people that like, oh, this junior drilled a discovery hole, it opened up 100% plus, so it's up to 20 million, I'm getting out. Whereas like, no, actually this story just got a lot better and with low risk, you should be getting in. I hope it makes sense. That's why it's like, personally, I'm much more inclined to do post-discovery plays, or if I do pre-discovery plays, I kind of have to make sure that the position is small enough that I can ride it for quite some time, because otherwise there's no way for these positions to pay for the many other high risk, high reward cases that don't pan out. I cannot afford to sell on a double if I need them to go up 10 to 20x to pay for the other high risk stories. I hope it makes sense what I'm saying. That's why it's like it feels much better that if you have a 1% position, they make a discovery, the stock goes up, so it makes up 2% of your position, and you're like, yeah, now actually this target is the risk. I think there's 10 to 20 bagger potential after it's gone up 100%. A 2% position of your portfolio, you're not going to be panicking, I don't think. Like, oh, I better take some money, this is such a large position already. So starting off with like, I guess my point is, and goes back to the fact that a lot of stuff sounds good in theory. Everybody has a theory. It's like I'm going to buy low, sell high. What people actually do in the market makes no sense most of the time, because the people that say buy low, sell high, they're the ones that also sell low, buy high. So again, everybody kind of knows what to do, but how easy it is to do. So even if you knew this, even if you know you had to ride the few winners for a long time without really taking much profit, okay, at face value, in theory, you know exactly what to do, because it makes total sense. I cannot sell the high risk juniors if they just go up 100%, because that's not going to allow the winners to pay for all the losers. So I have to stick with them. Then the question is, how do I actually do stick with them? How do I translate that theory into reality? If you start off with taking an enormous position size to start with, let's say you have 15% of your portfolio in a high risk, high reward junior, it opens up 100%. Now you're at 30% of your portfolio already, and probably will have a very hard time sleeping. But in the same token, if you have those kind of big positions, it's going to be impossible to diversify all the company risk, because if you have already 15% of your position in one high risk, high reward junior, that's only 85% of your portfolio left, and it's hard to de-risk that away, if you know what I mean, because you're going to end up owning like 6 high risk, high reward juniors. And if one works, it's going to be 100% of your portfolio. And that's the only, I mean, from a mathematical perspective, maybe one of those, depending on the risk, should be, you should have one win out of those 6, let's say. But again, in that case, then you have to stick with it for several hundreds of percent for it to pay for the losers, perhaps. So that's like in reality, that won't work. You won't be able to follow that. That's why, again, a big thing about investing, I think, and speculation is knowing what kind of investing theory not only makes sense on paper, in theory, but that you can actually, a strategy that you can actually execute. That is, I think, the big disconnect for a lot of people, including myself, and I try to get better at that all the time. First, come to the conclusion. What makes sense from a theoretical perspective? How would I need to play this? When can I sell? How does the buying and selling meet? Do I actually have a strategy that makes sense? And that's not enough. After that, you have to actually figure out, can this theory translate to how I actually do things? Or does it sound great on paper in theory, but when it actually happens, when all the requirements, let's say, maybe I'm screaming into my mic here a bit, sorry. Does it translate? Because let's be honest, it's like getting in shape or whatever. Everybody knows what to do, but everybody's not in shape. Why? Because while we know what we need to do in order to get in shape, most people can't execute in reality. That's the whole point. It's the same with investing. If you have a blueprint of, okay, if I do these high risk, high reward plays, I got to diversify away the company risk, whatever. And it's like mathematically, my portfolio should do well, even if 15 out of 100 actually work out. But that assumes that you let the winners ride long enough for them to pay for the losers. So if in reality you end up selling all your future 20 baggers after they pop 100%, that's a crap strategy, because you're never going to make money in the long run. Because if the 15% of cases that work out, if you sell that those on a double, you got 30%. But let's say the other 85% of the portfolio went down 60%. Well, it's like, it's just going to be hard. That's my point. So we kind of have to figure out, and that's up to each and any one. That's the problem. That's why you can't borrow conviction, and you can't even fully borrow a strategy unless you can actually execute it as well. If I come up with a good theory, high risk or reward theory, a good strategy, that's worthless if I cannot also execute it in practice. So you better figure out how you're going to respond to different things, and you better have a blueprint. if you're convinced, if you know that I cannot be selling some of these juniors after they go up 100% or whatever, because in that case this strategy doesn't even work. Because the ones that do work out will take 3 years to give me the kind of returns that are needed to pay for everything else. If you know that to be true, it hopefully will stop you from, again, taking huge asset risk, and the ones that actually end up making a discovery hole, and that's not even a guarantee for a discovery, but at least a discovery hole, and you cut them all down, you sell all after 100% pop, that strategy doesn't make any sense. And again, then you have to figure out, well, what would I have to do to actually be able to execute this? Well, typically that goes with smaller position sizes, because you're not going to be you're going to have more diversification and going to feel less stress. If you have a high risk, high reward case, it starts with 1% of your portfolio. Even if it goes up 200%, that's still only 3% of your portfolio. So you won't feel the emotional need to sell just because the pressure is on because of the portfolios or the position size. But if you start off at 10-15% and that goes up 100%, you're going to have enormous pressure. Plus, there's not really enough left of your portfolio to actually have proper diversification. So I hope that makes sense. Margin of safety and probability of upside, let's say, should coincide with or should correlate with the position size. Otherwise, it doesn't really add up. Otherwise, it's mostly gambling. If you take 3 positions in 3 high risk reward stories, I mean, you can kind of, okay, let's say there's 10% chance of success. 0.9 times 0.9. So that's a 73% chance that you're gonna fail. That all the high risk, if you have 3 high risk high reward stories, there's a 73, assuming a 10% chance of success, there's a 73% chance your portfolio is gonna at least be cut in half. But if you diversify that more, I don't know how many plays I did. Am I up to like 6 maybe? I don't know. Let's say 6 or 7 high risk high reward cases, equal weighting. Then there's at least 47.8% chance of success or chance of failure. You actually have close to 52% chance that you're not gonna get cut in half or more in your entire portfolio. And maybe one of those 6 or let's say 7 cases they do work out. Then they have to cover all the losses in the other 5 or 6. No, I'm up to more, I think. Let's say if you have 8 cases, the eighth one that actually, let's say, works out, have to go up so much. It means you have to ride it long enough for it to pay for the other 8. I hope this makes sense, and I think my main goal is to show that's theory comes first. Theory always comes first, especially in this kind of a probabilistic high risk high reward environment we're in. And then you of course have to deal with all the sentiment and news flow that changes things and all that. But main point is theory comes first, because everything is based on theory. Nobody knows what's going to happen in the market. The future is Schrödinger's cat. You own a stock now that is both not a discovery and a discovery, depending on what happens in the future. And there's a million different versions of that discovery. Not only that, you have to also factor in how you're going to respond. So you have to have a theory that makes sense, and you also have to come up with a strategy, theory, investing strategy that not only makes sense, but you have to follow it in practice. If you have a shitty investing strategy from the get-go, you're cooked. If you have a good strategy on paper, in your head, in your mind, at face value, but you can't execute that in the actual markets when the actual swings come or whatever, you can't hold on to your winner, let's say, that's needed to pay for the losers, then you're cooked as well. And this has been obviously a focus on more high risk, high reward plays. But I hope it at least goes to show why a lot of people, obviously, including myself, did mistakes in early on. That I took too big positions in high risk, high reward juniors, and the few that actually ended up producing some good results, I tended to sell them way too early. So basically, in reality, let's say I remember one stock, I don't remember what the name was, but they had one real target in Mexico. I had quite a big position in it. They had one project, one target, really, or one campaign. They could afford one made in real campaign. I took a big position. They ended up missing. Stock went down 60%. So actually, and I don't know, I don't think I even had a real plan for it, like what's going to happen afterwards. I didn't even think I thought about concepts like this, actually, sadly. So I mean, in I was going to say a nightmare scenario, let's say I put in 10-15% of my portfolio, and I should maybe have noticed, like, there's probably only a, let's say, even though I thought the target looked good, but let's say a 15% chance of success. Again, I cannot afford to take bets like that, big bets like that, where I'm going in, there's an 85% risk of that position getting cut in half. But if they end up making a discovery and it opens up 100%, then I'm going to sell my entire position because I'm happy to get a 100% return. That does not add up at all. Because if you think about it, well, 0.15% chance of getting a 2x. That's not worth much. And it certainly does not offset the risk of, there's an 85% chance there's an 85% chance I'm gonna get cut in half. That my $1 is gonna be worth half a dollar. That has a net expected value right now of $42.5, meaning minus 60 or 30, minus 57.5%. Expected value, that alone, and the upside is not enough. The upside of this $1 becoming $2 with a 50% chance of success is not enough, because that combined is 0.425, which is less than $1. So that bet actually has a negative expected return of 27.5%. So I'm giving away money to the market by doing that. So I would expect that's a money losing proposition. If you changed it, if you're like, there's a 15% chance that it's going to return 10x, that's worth $1.5. If you take away the the risk, or it goes up, 10x, so 900%. Then it's still then it's positive at least. But then you got to make sure that then you have to make, well, it's so I mean it's positive. So that's actually that's a good bet. But then you have to get the 10x, and you won't get that the day after the discovery, let's say. Big rant as always. But just again, I hope I get people thinking at least that you have to front run a lot of stuff, including yourself. You have to front run how you will react. That's why I like the Napoleon Bonaparte expression. I think it's legit. Where he said, you have to know what to do if the enemy shows up in the front, the rear, or your flanks. So you kind of have to be prepared for a bunch of scenarios, and you already have to kind of know what you're supposed to do if scenario A, B, C, D, E, F, G happens. That's why this kind of also shines light, I think, on the beauty of just sticking with good management teams. Because now we're talking high risk, high reward, probability based speculation theory, basically. Whereas I would say, okay, how do I make the simplest strategy there is? Where you don't need to think about stuff like this, like how much do the high risk, high reward plays need to return for me to offset the losses of the other high risk, the plenty of high risk, high reward cases that don't work out. Well, the easiest strategy is simply to bet. Let's say you have 20 juniors and you bet on people who've done that before, with skin in the game, growth stories, preferably with margin of safety. And then literally your strategy can be, I'm going to buy these companies that have whatever. Ross Beatty recently getting into it. Maybe Rob McEwen, maybe Pierre Lassonde and the Lundins. And the only thing you're betting on really is that, hey, if these guys are getting in at this price, and they're the best investors in the world, it means this is probably cheap. It doesn't mean can go down. It doesn't mean it can't fail. But if I have 20 said stories where they think this is cheap, and they are investing because they think there's a lot of value to potentially be created. If I hold that portfolio, those 20 names for 5 years, betting everything on these guys having a sense of what they're doing, you're probably going to make money. That is I think, the most foolproof, low maintenance strategy that makes sense as well, that you can possibly do. So the more advanced you want to be, the more high risk and where you need actual more diversification, and especially the higher the risk is, which means you need more diversification, then you have to make sure that you can also sit through the immense volatility. Where some of these, let's say Lundin plays or something, they might, they go up and down, but like on average they grow. So maybe expect to make 30% per year or whatever. It's not like a miracle. It's not a miracle returns. It might not be the most exciting whatever, but it's still probably the most foolproof strategy that requires the least amount of thinking and maintenance that I can come up with. And you're probably going to beat the GDXJ as well. So it's probably a outperformer. So it's like it's up to each and all of us to figure that stuff out. And we have to remember that almost nobody actually makes any money. Almost nobody knows exactly what they're doing. Well, everybody has an opinion, but again, most people's strategy, first of all, they don't really have a strategy that makes sense, Because it's the same with, okay, you have an alpha story, for example, where it's like, what's the main asset of the junior? It's actually the people. Okay, if you know that's an alpha story where it's like, these guys make such good decisions that the more decisions I let them do, the more value they're going to be creating. Meaning that I should make more money the more time I give them. If I give them 1 day, I have no idea if I make money. If I give them 1 year, I probably will make money. If I give them 2 years, higher probability of making even more money. 3 years, and so on. Why would you trade that? You can go and trade Dogecoin or Bitcoin or whatever. How much sense does it make to trade the main asset, which is alpha, which is time held? If you do short-term trading, the value of that alpha goes down to zero, basically. You're not even taking advantage of the most valuable characteristic of that case, which is the management, which correlates with time held, correlates with the probability of positive returns and the magnitude of the returns. If you do short-term TA whatever, you're wasting that whole thing, because anything can go up and down at any point in time. And in those cases, you would even say that the surprises to the upside are more probable and plentiful than surprises to the downside, especially compared to all the other juniors. And surprises, per definition, means that they are surprises. How do you trade a surprise, let's say? If you're buying after the fact, that's not you getting the benefit of the surprise, right? Because then it's not a surprise anymore. So why on earth, or how on earth could I come up with, how I really take advantage of this management team's quality is by trying to trade it? Then you're missing the whole point of the value of the management team in the first place. Again, that makes sense on theory, right? But you see all these alpha plays, let's say. You see where the Landins are in, for example. And there's going to be people trading it much more than people sitting still in them. The actual people that make the big money are the ones that just held it for the longest time. Because the Landins, for example, tend to, sooner or later, make stuff work, even if they have to find another project. And they have access to capital, so they can, try their different theses. This, I hope this makes sense. But it's just that it's so goddamn boring in a sense, or it's like, what do you mean? All I have to do is bet on this management team, and then just, pretty much hold on for as long as I can. Like, yeah, I could say that I think you will have made more on this play with a good management team in 3 years than you would have done in 1 year. And the probability of success actually goes up with time held, as do the returns. But if you're a short-term trader, it correlates with nothing. I held a stock for 2 days of a alpha play. It's like, who knows? Maybe the value went down that day. You have no idea. Maybe they were on a vacation, a management team, so no value was created. Long rant again, but I think these are important things, and it's like I do this also to remind myself of what makes sense. When it comes down to it, it's like, again, if we're talking low maintenance, sensible strategy, then it's like bet on the people. And the probability of returns and the magnitude of returns correlates with time held. Meaning that if I want to have high returns and a probability of getting returns, if I held that stock for 3 years, there's a higher probability of me having made money and the money being larger than if I bought it 2 years from now and held it for 1 year, because the delta is much bigger. In 3 years they would have created more value over 3 years than over 1 year. So if we have one universe where I held the stock 1 year, there's a lower chance I actually made money, lower chance the expected money I would have made would be lower than if I gave them 3 years to create value, because they can create more value over 3 years than in 1 year, and there's a high probability they would have fixed problems, overcome hurdles and challenges in 3 years. Because a good management team finds ways to solve problems and create value. A bad management team creates problems in the long run, capital destroyers. So it's like a good management team, the longer you hold it, the better it is. With a bad management team, the longer you hold that stock, the higher chances of you losing money, and the degree of money you're losing, the magnitude of money lost goes up. Completely two different things. But if you would be trading them, they might look somewhat similar, if you know what I mean, because sentiment plays part, short-term sentiment plays part in both scenarios, but there would be more upside surprises in the good management team run company and more downside surprises in the bad management team run company. So again, from a trader, doesn't really matter that much, but as a holder, you're gonna get those surprises. That's gonna be attributed to you. You have if you own the company before the surprise, you're gonna catch the revaluation after the surprise. If it's a bad management team, you're gonna probably be holding into a lot of negative surprises. If it's a good management team, you're gonna be holding into consecutive good surprises. Again, I hope that makes sense. Thanks for listening. I don't know how many companies I covered. I thought about covering a bunch of companies, but I actually ended up doing a high risk, high reward rant and stuff. But consider me biased. Do your own due diligence. Thanks for listening. This is not investing advice. Bye.